Imagine handing a machine $5,000 and walking away without hope, fear, or excitement. You don't watch it like a gambler. Instead, you set rules, define limits, and give it a strict 6-month clock. What comes back isn't a jackpot, a storybook ending, or a viral success. It's a ledger. A ledger that quietly reveals patterns of math, bias, and the subtle ways risk hides in plain sight. By the end of this video, you'll understand whether an AI trading bot is a genuinely useful tool, a risky toy, or somewhere in between, and you'll leave with a simple, practical checklist to evaluate any bot for yourself. No hype, no speculation, just evidence. Behavioral finance uncovers human errors, AI exposes the machine's mistakes, and this video shows how the two intersect. Here's the journey we'll take in this video. First, we'll look at what the experiment actually involved, the setup, the constraints, and why running a simulation was the smart choice. Second, we'll dive into how these bots operate, exploring their mechanics and the single most common trap they fall into, overfitting, and the third part walks through month-by-month results, not just showing profits, but examining key risk metrics to reveal the real story. And at last, we'll see the results and analysis. In the first section, we'll dive into the setup and explore how to structure the experiment effectively. At the heart of any meaningful experiment is a simple principle: isolate the rules, the capital, and the method of evaluation. If you don't control the rules, the results end up controlling the story, and that's exactly what we wanted to avoid. We didn't hunt for some secret magical trading bot. Instead, we created a reproducible, conceptual simulation that mirrors how a typical retail automated strategy would operate on a standard trading platform or brokerage API. The setup was straightforward: $5,000 in starting capital, a strict cap of 1% risk per trade, no leverage beyond 2x, and a full cycle of backtesting, followed by paper trading signals applied retrospectively over historical and live simulated markets. Why run a simulation instead of using real money? Real capital brings legal and security complications, while backtest can reveal structural flaws much faster, if and only if you test them properly. Backtests are a powerful tool, but they can be dangerous when misused. As the saying goes, a strategy that fits the past often fails the future. In the next section, we'll uncover how the bot actually thinks and what drives its decisions. At its core, most retail AI trading bots aren't wise investors, they're relentless pattern finders, spotting correlations rather than understanding causation. Imagine the bot as a tireless autopilot, navigating a map built from yesterday's weather. It follows the paths it knows, but it can't predict the storm ahead. The problem is that this map is often contaminated with ghosts, backtest ghosts, that make past patterns look more reliable than they truly are. Some bots are simple and rule-based. If X happens, do Y. Others use machine learning, from neural networks and reinforcement learning to basic regressions trained on price, volume, and alternate signals. Machine learning can uncover real edges, but it can also mistake noise for signal, a phenomenon called overfitting, the silent killer of automated strategies. Overfitting shows up in practice as too many parameters, endless tweaks to historical data, or too good to be true Sharpe ratios on past performance. The right approach uses purged cross-validation and conservative walk-forward testing to separate real insight from illusion. As a rule of thumb, if it's perfect on paper, it's probably lying. In the third part, we'll examine the experiment month by month and track the 6-month journey. Short-term luck and market volatility can easily masquerade as skill, which is why evaluating an AI trading bot requires multiple metrics, not just raw profit. Month 1 feels exciting. The bot opens positions, posting small gains as simulated trades produce modest winners and losers. Early success sparks enthusiasm, but much of it reflects favorable market conditions rather than genuine edge. By month 2, a drawdown appears, a single market swing exposes the bot's sensitivity. While it hits its per trade limit, the maximum drawdown isn't breached, and you quickly learn the importance of proper position sizing. Month 3 reveals overfitting signs. Patterns that performed during training begin to wobble, win rates dip, yet the average return per winning trade remains meaningful. Month 4 brings rebalanced stress as the bot chases higher turnover patterns, and even simulated fees and slippage start to bite. Month 5 demonstrates the impact of market regime shifts. Trend reversals punish momentum-based rules, leaving the bot underperforming a simple buy and hold benchmark for weeks. By month 6, the simulated $5,000 grows or shrinks by a modest percentage, but raw profit alone tells only part of the story. Compared to an S&P equivalent benchmark, The bot may slightly outperform in volatile periods or lag during trending bull markets. As the saying goes, profit without a tolerance plan is just a number. In the fourth part, we'll examine the results and dive into the analysis. When it comes to evaluating AI trading bots, metrics matter far more than flashy headlines. The top-line number is often just a clickbait cousin of the real story. In our conceptual simulation, the final capital grew by about 6% over 6 months, with a maximum drawdown of 9% from peak to trough. The annualized Sharpe ratio, scaled for context, was modest, consistent with conservative automated strategies. These numbers highlight an important truth. Small, absolute gains can coexist with uncomfortable swings, and volatility has a way of amplifying behavioral risk, as humans often abandon strategies after a rough patch. That's why combining machine consistency with human discipline is crucial. Beyond performance, there's also the regulatory and fraud dimension. Scammers frequently exploit the buzz around AI to sell trading bots, and regulators have actively pursued fraudulent platforms in recent years. Transparency and vigilance matter more than ever. As the saying goes, if a bot can't survive a single regime change, it isn't a system. It's a memory trick. Now, let's tackle the common fears and walk through straightforward playbooks you can use. It's natural to hesitate before using AI trading bots. Concerns about privacy, losing money, being misled, or becoming overly reliant on a machine are common and understandable. The reality, however, is more nuanced. A well-designed AI can sift through massive amounts of data quickly and efficiently, uncovering opportunities you might never spot on your own. But a poorly designed AI can do the opposite, amplifying human errors or embedding invisible biases from its data or model. Banks, for example, use AI for fraud detection because it scales effectively, yet even these systems aren't perfect. To navigate safely, simple, actionable playbooks make all the difference. Start with paper testing. Run the bot on historical data using conservative assumptions for fees and slippage. Next, move to small-scale live testing, allocating only a tiny portion of capital separate from your core holdings. Keep a detailed audit trail with trade logs, justifications, and strict override limits to maintain accountability. Finally, embrace diversity. Pair algorithmic strategies with passive holdings, avoiding the risk of putting your entire financial identity into one model. Above all, remember the mantra, trust but verify, always verify. It's a simple, powerful principle that keeps both AI and human judgment working together safely. Now let's explore the real-world signals and the risks they reveal. Automation is no longer a niche experiment. Companies and funds are investing heavily in AI, making it mainstream. Yet adoption in retail and banking is constrained by regulatory and operational limits, creating a gap between capability and accessibility. Enforcement is real. In 2024, the SEC pursued sham platforms and social media-driven scams, while security reports show scammers leveraging YouTube and malicious code to trick unsuspecting users. As the saying goes, big tech builds tools. Small scams steal trust. Let's close the loop on the two questions we started with. Can an AI bot provide reliable returns? And is it inherently safer than human decision-making? The tentative answer is clear. Sometimes, AI trading bots are tools that can reduce certain human errors and highlight patterns, but they do not eliminate risk or guarantee superior long-term returns without rigorous testing, honest metrics, and a human actively in the loop. Comment below with one number, how much you'd risk on a bot 0 to 100%. I'll reply with a tailored, principle-based note on what that allocation should realistically look like. No hype, just rules. Machines can process numbers faster than we ever could, but they don't care about our choices. Use that speed wisely. Own your decisions.